Welcome to the Allan Small Financial Show. As always, I want to thank all of you for taking the time out of your busy day and spending it with us. It's interesting when I look back on the last few shows that we've had, and as you all know, we come on air every other Wednesday at 12 noon. But for the last bunch of shows, they've been similar. At least the themes have been similar. We've talked a lot about trade. We've talked a lot about tariffs. Two of the T words, as I call them. You can even add maybe a third T word, taxes. The tax bill going on in the U.S. right now that is trying to get passed. So whether it's taxes out of the U.S., trade, tariffs, a lot of it is a lot of I guess the questions are stemming from what's going on in the U.S. more so even than what's happening here in our country. And so that's why we're talking a lot about the U.S. because what they do, what they say, the kind of trade deals they want, the agreements that they want to make, obviously is affecting us here in our country, forcing us to do things, to relook or to look again at some of the things we're doing in Canada, perhaps taking down trade barriers, perhaps finding new trading partners around the world for our goods and services. So a lot of what's happening, a lot of the questions, a lot of the volatility, the confusion, definitely stemming from the US and the Trump administration. And that's why we talk a lot about what we have been talking about or discussing and answering as many questions as we can on these topics. Today's show is really no different. We're going to put up our topics for today. Here you have our first topic. Trump called for best trade offers. President has made an announcement to everybody in all countries saying to put your best foot forward. Come with a good trade deal. We want to hear your best trade deal because I guess that I shouldn't say we, but the U.S. wants to hear your best trade deal and wants to negotiate. And we're going to discuss these trade deals and these negotiations and why the president is again stressing that countries need to come forward at this time. Second segment are top three things that individual investors need to consider before they make their investment decisions over the next 5 to 10 business days. Again, very popular topic for our viewers, and we'll get into our top three for that segment. Segment number three, Magnificent Seven continue to outperform the S&P 500. All I've heard for the last few months is that the Mag 7 are done. They've had their day in the sun. The shine has come off these big cap tech names. Well, after the first quarter and earnings came out, that is definitely not true. And we're going to talk or show you some of the numbers and how powerful these big cap tech and Mag 7 names actually are to our economy, to the U.S. economy as well. Gold prices vary as news of trade agreements change. It's interesting. Anytime we get some gyrations in the price of gold, it usually means that we're seeing some positives with respect to the U.S. economy. Maybe we're closer to some trade deals. Maybe we're closer to passing a tax bill in the U.S., to seeing a tax bill being passed in the U.S. All of that really can help bolster or boost the U.S. economy, the U.S. dollar, and that is definitely a negative for gold. And when there is chaos on the flip side, we tend to see gold move higher. And when their debt levels are increasing, and there's talk about that, gold moves higher. So you have that back and forth. We'll get into that as well. Our fifth topic, being patriotic is a great thing, except when it comes to investing. I love to hear everybody talking about, traveling within Canada, doing business, taking down, as I said off the top of the show, interprovincial barriers. These are all positive things. Spending more money in Canada, Canada doing better deals amongst ourselves as well as amongst other regions of the world. This is all positive. Being patriotic, loving our country is great, except when it comes to investing. And I'm going to show you some numbers just on how important it is to invest outside of our country if you want to see your portfolio grow over time. Quick hits, three ideas or three topics or things that I've seen in the news recently that I think most of you have seen as well. I'm going to comment on all three. And at the end of our show, of course, as always, I will try to take as many questions as I can from the audience or questions that I've received over the past couple of weeks. And we usually get to one or two of those. So without further ado, let's get on with the show. So President Trump has recently told all countries that you need to come forth and give us your best trade offers. And he's made that announcement because, as most of us know and have realized recently, that that 90-day pause in reciprocal tariffs is actually coming due the first week of July. Here we are, June the 11th, and we're maybe 3 weeks or so away from the deadline where the president may, and as I say, may put back on these reciprocal tariffs. And so, is this a warning by the president, or is this the president making one last, call to different countries to get a deal done? In my opinion, I think the president needs to get these deals done. I don't believe that he can go back and put these tariffs, at least at the levels that he once stated them at, which was, I believe, back on April 2nd. He came forth and announced a whole bunch of tariffs, very high levels of tariffs on many countries. To me, the president always talks about, doing a trade deal, but if the trade deal doesn't get done, President Trump says, well, we'll just go back and put back the tariffs. I just don't think it's as easy as that. I think there's a lot of pressure on the president to get deals done. And obviously, the China deal that they've just negotiated, we're hearing some of the details coming out just this morning, but I would say the first details aren't so good. It's kind of a mini deal, if you will, just the U.S. trying to get hold and get and secure some rare earth elements. But we're not hearing really much of what the U.S. has given up to secure this deal. So I guess in the coming hours or days, we'll hear more about that. But overall, in my opinion, I don't think that the president is negotiating necessarily from a position of strength. I think with many scares out there right now for the Trump administration to deal with, such as perhaps if tariffs or trade deals are negotiated, will we see higher pricing in the U.S.? We're keep waiting for higher pricing to show up in the U.S. We're hearing businesses like Walmart, Amazon, automobile companies, many other businesses, whether it's toys or anything else for that matter, services, goods. We're hearing that prices are going to go up. So does the Trump administration want to see higher levels of inflation, prices going up? I don't think so. And does the president want to see empty shelves in general when it comes to the back to school season or the holiday season, whether it's Halloween or Christmas or Thanksgiving? I don't think so either. We're hearing about challenges in the courts to these to the tariffs in general that are being proposed or levied on countries. Right now, the courts are saying that the president has the leeway to have these tariffs put on these countries, but that could disappear as well. And what about Republicans in general? They're having a difficult time passing their tax bill in the Senate right now. A lot of things not going the president's way, but you keep hearing from President Trump that everything is great, that everything is fantastic, even though his approval rating is quite low and one of the lowest we've seen from presidents after 100 days in modern history. So a lot of things going against the president. I think he's asking for country's best foot forward because he really wants to make some deals. And let's go to our first illustration here. This, if you recall, anybody who was watching President Trump's, announcement on April 2nd, he pulled out this, I guess it was, a chart that he actually held in his hand. And this was actually the chart he held out. And you could see all the crazy amounts or the crazy levels of tariffs. Vietnam, 46%, European Union, 20%, Thailand, 36%. I'm just picking out some of them. Pakistan, 29%, right across the globe, all the different tariffs that were announced on April 2nd, which obviously has since gone into hibernation, if you will, or definitely a pause for 90 days until, I guess, first week of July, which is when that pause will expire. The president calls for trade deals, trade negotiations, but trade deals take a lot of time to make. Our next chart just shows you how long it can take or how long it normally takes to make a trade deal. Perhaps the president wants to get, I guess, the framework for a deal, maybe the foundation of a deal. But I would think trade deals are going to take a lot longer than the next few weeks to get done for certain countries. And you can see here, current timeline to make trade deals. He's giving a 90-day timeline as of April 2nd, but you can see the US, Canada, Mexico agreement, how long that took, how many days that took, a lot longer than 90 days. Typical time frame is usually about 917 days to have one of these trade deals done. You can see where the 1,000-day mark is on the far right. The U.S.-Panama Trade Promotion Agreement in 2011, you can see how long that took. So trade deals, getting them done, I think he announced 90 deals in 90 days. I think to me, always sounded a bit on the I was a bit skeptical that he could get it done, that his administration could get it done. They seem to think they can get it done, but I'm just not so sure. And overall, it just leaves individuals, Americans, and really Canadians, all of us, skeptical as to what is going on and what can actually get done. And the skepticism is actually playing out quite a bit in the president's approval rating. Our next chart here shows President Trump's approval or disapproval polling results. You can see here, depending on which poll you look at, whether it's CBS News, 55% disapproval rating. I guess the highest approval rating is Marquette Law School, 46%, still not even 50%. The lowest comes in at 40% on this chart. CNN, 41%. NBC News, 45%. So you can see clearly that his approval rating is anywhere between 40 to 45, 46%, whereas his disapproval rating tends to run anywhere between 55 and 60%. That is something definitely I'm sure that the president is not so happy about. But again, it all comes down to trade deals. And if trade deals can be made, can be announced, at least the framework of trade deals. And, I think trade deals, at least for the U.S.'s major trading partners, will be most important. Canada, Mexico, China, UK, maybe even throw in Japan if you like. I think those are the main countries that the U.S. is looking at making a trade deal. But the market thinks, at least for now, that trade deals are going to happen, because our next chart clearly shows how well the market has done, the S&P 500. Look how the S&P 500 has performed since, let's call it, the first week of April. It is up significantly, wiping out all the losses for the year on the S&P. TSX is actually in positive territory. The S&P is in slightly positive territory. NASDAQ has come back. All the major U.S. indices, as well as the Toronto Stock Exchange, come back and now showing slightly positive to nicely positive returns. I think the TSX is up somewhere around 6% for the year. So far, you can see here how well the S&P 500 has done. Unfortunately, or maybe fortunately, this bond market too has been telling a bit of a story. We can show the 10-year Treasury here, and you can see gradually that the 10-year Treasury has moved towards that 4.5% level. We've seen it as high as 4.6%. The 30-year has actually gone above 5%, and that's a bit of a negative, right? When debt levels, or the expectation that debt levels are going to rise due to a tax bill being, I guess, approved by the Senate, already been approved by the House, but once it's approved by the Senate and signed by the president, we know debt levels are going up in the U.S. Bond market does not like that. And when the bond market or bond yields rise, you know that the stock market tends to fall. So we're also keeping an eye on 10-year treasuries. So overall, the president of the United States right now, President Trump, wants the best trade offers he can receive, because I believe he is under the gun to make deals. He may not say that. He may not act like that's the case. We know that the president is a great negotiator, and if he were to show weakness, definitely that would not be good for negotiating. So for now, we're going to assume that things are on pace to, or on track to come up with a bunch of trade deals. We've heard Howard Lutnick recently, part of the Trump administration, talk about how deals are going to be announced in the coming few weeks before the deadline. So just going to have to wait and see. And as I said, for now, the market is acting positive because it believes that trade deals are coming. Now, the part of the show where we talk about three things that individual investors should be focused on before you make your investment decisions. Of course, what is number one? Trade deals need to be top of mind, especially as I briefly mentioned just a few minutes ago, between China and the US, and also major US trading partners. Inflation and Federal Reserve interest rate decision. The Fed's going to make an interest rate decision in the next, well, let's call it next week, week and a half. And we're going to hear what Jerome Powell is thinking. We know the president, just based on this morning's CPI data, which came in below expected. So again, inflation in and around 2.4%, just above the 2% target that the US is striving for, or the Fed is striving for. And obviously, the president is calling for a full 1 percentage point drop in interest rates. Not sure that's going to happen this year or anytime soon. Our third topic, our third idea, some stocks are now fully valued. I guess a couple of months ago, back in April, there were many things that were on the cheap, and I came to you and said, this is the time to improve portfolios. This is the time to better a portfolio. Take out some B names, put in some A quality names because they were cheap. Well, a lot of those A quality names have gone up in value and now are fully valued. So we'll discuss that. So let's get to the first one. Trade deals are top of mind, especially with our major trading partners. Our first chart clearly shows who our major trading partners are. There you have it. Mexico is the U.S. Major trading partner, with along with China and Canada. Obviously, China being the second largest economy in the world, very important for the United States to get a trade deal done with them. But of course, trade deal with us here in Canada and a trade deal in Mexico is extremely important, and we go a long way to, I guess, quell investor fears and to really get economies moving forward again. And as I said, I think when we look back, I believe years from now, I think we're going to look at this time as the turning point for our country, the time when we didn't rely as much, or we started to rely less on the United States and start to forge our own deals with other parts of our country, meaning interprovincial, but as well as forge deals with Asia, Europe, other parts of the world, Africa, provide what we take out of the ground and what we build to others, other places in the world, and not be so reliant, not send 70 or more percent of what we build and take out of the ground to the US. Perhaps we should start looking at sending it to other places. So those are the three major trading partners to the US, of which we are one of them. Our next chart here shows what tariff threats mean for the US economy. And we have that here. You can see that how much the China trade has surged over the last 20 years. Although you can see since we, I guess, the point where the Trump administration put tariffs on China, you could see that it's been an up and down sort of thing. And you can see how US imports from China have definitely lagged. We're going to see that in another chart in just a few moments as well. But you can see the reliance on China and trade with China, imports from China, how much they've gone up. And you can see exports to China, how much those have gone up as well. So China, major trading partner for the United States, which is obvious. They need to get a deal done. And it shouldn't just be a deal for rare earth elements. What about everything else? What about all the other areas of trade that U.S. does with China? Our next chart again shows the importance of China to the U.S. You can see here, share in China's exports, how much exports to the United States. Look how great, how much more goes to the U.S. than anywhere else in the world today. These are the export markets. This also includes Hong Kong. But overall, you can see the dot there representing how far out the United States is from anywhere, even regional partners such as South Korea, and Vietnam, and Japan. The United States is by far the largest destination. Our next chart here shows China's share of U.S. imports by category. And I like this one because it shows us what's the biggest thing the U.S. brings in from China? Toys. I think it's something that perhaps if we had to guess, you may not have guessed. But when you think about it, toys, how many toys do we see, even in our country here in Canada, come from China? Quite a bit. And so when there is a tariff placed on China and goods coming from China into the US, that just means that the toy season or the gift season or the holiday season is going to be a lot more expensive in the US, whether it's Halloween, whether it's Thanksgiving, whether it's Christmas. Right now, there's talk that perhaps 55% tariffs will remain on China. That is the 10% from this year, the baseline, plus another 25% for the fentanyl, and then the 20% tariffs that the Trump administration put on China from the first term, from the previous term that President Trump was in power. So it's interesting. The one takeaway I would have here, though, is if you look at the 2017 line, which is in the gray, and 2023, you can see that imports from China have definitely come down, and we saw that back in the previous chart. So even though the U.S. is still very much reliant on imports from China, it has gone down quite a bit from where it was in 2017. Our next chart, another one here, trying to go through them pretty quick. This is about rare earth elements, and you can see here just how much China makes up of the world's rare earth elements. Something like almost 50% of rare earth elements come from China, which is why it is so important for the United States to make some sort of trade deal. And we've heard just this morning that a deal has been reached so that the U.S. can continue to get these rare earth elements from China. There will be no stoppage. The question is, what has U.S. given back for this negotiation? And there's also talk that more trade talks will take place in the coming weeks. And I think it'll be interesting to see when the details are announced, probably later today or maybe in the coming days, what it is that the U.S. is going to give back. Perhaps it is semiconductors or chips to China in return for these rare earth elements. So trade deals, you want to keep that top of mind. Second point, and we always have one of these points in our top 3 things to consider, which is the economic data out of Canada, out of the US. And we just received inflation data out of the US this morning. CPI, Consumer Price Index, showed that prices continue to come down. Headline number was below expectation, 0.1% growth month over month, which was very low. And inflation rate coming in at 2.4%, below the expected rate of 2.5. We saw that the volatile core, which takes out volatile food and energy, we have a chart we can show that, shows that that rate or CPI rate is 2.8%, and that has remained pretty stable. So headline number 2.4%. Core, which takes out volatile food and energy, which I always say you can't really take out, but Federal Reserve likes to take a look at core numbers. That comes in at 2.8%. Tomorrow, we're going to get wholesale prices out of the US, which is your PPI number, Producer Price Index number, rather than Consumer Price Index. Our next chart shows that we're expecting a number somewhere around 2.4%. If that were to increase, perhaps that would give us an indication that wholesale prices have moved higher, and then in turn, maybe consumer prices will move higher in due time. And again, we're still waiting for that data to show us that inflation is ticking higher and prices are moving higher. We keep getting warnings, but no data to back it up as yet. Our next chart, Fed funds policy rate. You can see here that it's still in that 4.25%, 4.5% range. The Fed has been on pause for the last couple of meetings. Bank of Canada has been on pause from the last couple of meetings. Both of them are saying economies are doing well. We just had some economic data out of our country showing that we have growth of roughly 2%. So Are you going to lower interest rates when the economy is doing well, when employment in the US is at 4.2%, still pretty low? Probably not, even though President Trump is wanting the Fed to cut rates in anticipation, perhaps, of things to come. It doesn't look like the Fed is looking to cut rates anytime soon. So we want to continue to focus on the economic data, inflation data, jobs data. We just had it for May. It looked okay, coming down a little bit, still strong enough for the US market, strong enough for the Canadian market as well. But we want to continue to look at economic data to give us an indication on how the stock market will move forward. Our third and last point is this idea of fully valued stocks right now. We've seen a lot of bargains in the last couple of months. A lot of these names have been bought up. A lot of that has been buying by retail investors. And it's funny because they always say the smart money is moving out when retail investor is moving in, and vice versa. Well, I'm here to tell you that the retail investor was the smart investor this time, when some of those institutional investors, the smart money, the savvy investors, as we call them, the ones that should have their finger on the pulse of the markets, when they were selling back in April, it was the retail investor actually that was coming in and buying up the bargains, and the retail investor was right. And we've seen the stock market bounce back from a 20% decline on the S&P 500, bear market territory, all the way back to break even, and now a bit on the positive side. A couple of stocks I wanted to highlight for their performance that we talk about on this show often. Our first stock, TD Bank, a name that was left for dead, I guess, months ago because of the issues down in the US, because of their situation, their compliance situation, money laundering and their fentanyl and all that we heard that the issues they were having. Well, take a look at the stock. You'd be hard pressed to find another Canadian stock or Canadian bank stock even that has performed better. TD Bank has gone from a stock in the high $70 range to a stock that's almost reached $100 per share. An unbelievable run. Things are getting better. We've seen a change in management. We've seen things improving in the US. We've seen TD Bank selling off Charles Schwab, part of their investment in Charles Schwab, another great company that has brought in a lot of money. So TD Bank has a lot of money there to do things with, whether it's buy back stock, increase dividends, or eventually perhaps make an acquisition here in Canada or somewhere outside of Canada. We know they can't do anything right now in the US, but perhaps if that rule is relaxed, they will be able to go in aggressively into the US market. Another bank stock that has done extremely well, CIBC Bank, once upon a time again, on sale. Today, sale is no longer there. Dividend yield is not as high as it once was, in the 4.5% range. Once upon a time, it was a 6% dividend. Because the share price has gone up, that dividend rate has come down. And probably the best bank, one of the best performing banks anywhere, this bank, the biggest bank in our country, Royal Bank. Look how well that stock has performed. Kind of leveled off in that 175 range, and it's got up to maybe 178, pulled back a little bit. But again, another bank stock that has not, or at least has performed extremely well and no longer offers you a discount to buy the shares. And our last stock here, I thought I'd change it up a little bit, show you a tech name, Broadcom. These are the guys that have a very diverse business. A lot of their business, and the main reason for their stock rising lately is their chips that are involved, custom chips for artificial intelligence, but they do software and they do a bunch of other things as well. You could see once upon a time, Broadcom back beginning of April, first week of April, was down below 150. Now look at the stock. Stock trades 240. It got as high as almost 270. But a name that right now I think is fully valued. So as an investor, I think you got to be mindful of which stocks you're looking at. Once upon a time, many of them were on sale. Today, I think they are fully valued. There's still a lot of bargains out there to be had. You just have to do your homework or ask your investment advisor, ask myself. A lot of things I'm still looking at purchasing. So the bargains are there. Bargains are really always there. You just have to do your work to try and find them, as we say. Always a bull mark somewhere. We just have to find it. So keep an eye on the data, keep an eye on the trade negotiations, and keep an eye on where stocks are trading before you make your investment decisions over the next few weeks. So we've talked about the Mag 7 on our show many times, and I don't want to really have this or discuss this topic for too long, but here you have the Mag 7. And obviously, most of them, if not all, you can even say Tesla is a tech stock, depending on how you look at it, with all the different companies that fall under Elon Musk. It is a bit of a diversified company, not just automobiles, but most of the names there are in the tech space. And there's been a lot of talk recently about Magnificent Seven or big cap tech stocks are kind of falling off, softening up, not really carrying this market as much as it has over the last few years. Well, I never really believed that. I still don't believe it. And now we have the data to actually show you that this is not the case. Our first chart, we can show Magnificent Seven outperformance. There you have it. These are earnings growth year over year for the Mag 7 versus the other 493 companies on the S&P 500. 27.7% earnings growth for the Mag 7 as a group versus the other 493 companies. 9.4% growth. Almost 3 times as much growth we're seeing in earnings from the Mag 7 as we're seeing from all the other companies, all the other 493 companies. Look how much this has jumped from March, just March, from March to today. March was significantly lower. We're seeing today, almost the end of Q2, how much the Mag 7 are dominating. And as I tell people all the time, I don't think you want to own all the Mag 7 names. I think you want to be, pick your names that you want to get into. Try and pick the winners, because even within the Mag 7, we have winners. And we have names that haven't done as well. Some of the names that haven't done as well, Apple, for instance. That stock has been struggling with artificial intelligence and incorporating AI into their products. Tesla, with all that's going on between Elon Musk and President Trump, we've seen that stock go significantly lower and then bounce and then come lower and then bounce back. So there are a number of names that one might think, or investors might think, are more fully valued or overvalued, perhaps. Maybe Apple. I've heard a lot of people just say that Apple has been overvalued for quite some time now, because their growth rates are at best mid to high single digits, and their stock trades at a multiple of 30 times. So significantly overvalued. But you really want to take a look at some of these names, and I have charts on just a few here. First one is Meta. You can see how well Meta has performed. A lot of that growth has come from Meta. Meta has been, if not the best Mag 7 name, could be the best tech name out there in the last little while. A fantastic chart. Amazon, in my opinion, Amazon, Microsoft, these are the two businesses, companies, I think are the best companies in the world today. So diversified in so many areas, whether it's cloud, whether it's artificial intelligence, whether it's groceries, pharma, or just being an online retailer in general. You can buy anything from Amazon now. And I think it was just my wife this morning said she ordered something from Amazon late yesterday, and it was at our doorstep this morning. So a great, great company, and a name that definitely investors, I think, need to take a look at. NVIDIA, another name that I believe we've talked obviously on this show many times about, but a name that a lot of people left alone for a while. You can see how it performed in April, and at the end of April, stock was down significantly because of trade war, China-US, this idea that perhaps you didn't need to spend a lot of money to have artificial intelligence, DeepSeek, things like that came out. That all proved to be, well, water under the bridge, perhaps. We'll have to see going forward, but NVIDIA, a lot of great contracts between them and countries in the Middle East, with the recent trip by President Trump drummed up a lot of business for NVIDIA. Perhaps NVIDIA chips will be sent back to China once again in the coming days or weeks with a trade agreement between the US and China. So a lot to see there. So these are some of the names I wanted to highlight with the Mag 7. I think you could take a look at this group. I think you have to take a look at this group. I think you have to take a look at tech in general and add one or two names that you're seeing on your screen if you're looking for growth. And I think you need a market weight or at least a pretty good component of technology to have really good growth, especially in a growth portfolio. And for those that are looking for good return, 8, 9, 10% or greater, technology is where we've been getting a lot of that growth, and I think where the growth is going to come in the coming years. So a quick note on gold. As many of you know, not the biggest gold bug. Obviously, gold has been, I think, the best investment idea that investors have put their money into over the last little while, last year or so. Gold has been the best performer, even when the market was going down and in bear market territory earlier this year. Gold wins, right? Whenever there's chaos in the world, whenever there's uncertainty, when the US dollar is weak, when the US economy is weaker, gold prevails because gold is priced in US dollars. We have a chart on gold, and it is really the only chart for this segment. We can show you how well gold has done. There it is. But you can see the choppiness. And gold, I guess, since maybe mid-April has been in a range, right? It's been trading in a range. And that is because since mid-April, we've been hearing about trade negotiations. So what's it going to take for the US economy to go higher, the US dollar to go higher? It's going to be trade deals. And if we do see trade deals, we're hearing one right now, as I've said, with China and the US. We're hearing rumblings that we could hear a US-Canada trade deal, US-India trade deal, perhaps even a US-Mexico trade deal in the not-so-distant future, US-Euro deal. If we get those trade deals, in my opinion, this is what's going to boost the US economy and boost the US dollar. And that should be a negative for gold prices. So for all of you that own gold in your portfolios today, that you've made a lot of money on, you need to keep an eye on what's happening with respect to the trade negotiations. You need to keep an eye on anything that's going to strengthen the US dollar, the US economy, because that is a negative for for gold prices. When there's less chaos in the world, and I think there will be if we get some trade negotiations, if tariffs are removed or significantly reduced, I think that is a negative for the price of gold. So for all of you that have had this great trade, you've owned gold, whether they're gold stocks, gold certificates, I think, or some people may even just own a bar of gold or gold coins and they keep them in their safety deposit box. It's been a great trade. It's been a great run for gold. I just think maybe, just maybe, that run is coming to an end. So keep an eye on the trade deals that are happening and keep an eye on the stability of the US economy. Being patriotic is a great thing. Loving your country is a great thing. I'm born and raised in Toronto, and I love my city. I love my country, and anything I can do to help better our city and our country, I'm all for it. So being patriotic is great. You've been hearing a lot about people sticking to Canada with respect to travel, buying Canadian versus product coming in from other countries, helping local businesses at a time when costs are definitely rising. These are all fantastic things. However, when it comes to investing, being patriotic or trying to stay within our borders, not a good idea. Understand, Canada only represents about 2 to 3% of the world's wealth, whereas the United States represents 20, 25, maybe even closer to 30% of the world's wealth. You need to have investments outside of our country. There is no doubt about that. And so with that in mind, I talk to people all the time, and they're telling me, should we, just buy Canadian bank stocks, collect a dividend when the times are volatile? Staying out of the volatile areas, which have been the United States and US investments. And my answer is no. When there is volatility, there is opportunity. And we saw, and I've just showed you how well the markets have done recently in the US and how much money individual investors have made, those that had the iron stomach to buy into the US markets, even the Canadian markets, buying in general when times were tough back in March, April, those that bought rather than sold out of panic, you have been rewarded. Our first chart here shows US stock market versus the rest of the world. This is an interesting chart, and I think a great chart. So the US stock market is in the gold, the global equities. This is the MSCI All World, excluding US, of course. So this is everywhere else outside the US. And you could see how often the gold line goes up versus the purple line comes down. You can see really since 2010 how much outperformance, or how many times the US markets, US equity markets, US stock markets outperformed the rest of the world in the last 15 years. Quite a bit, quite a bit. And just, you can see just there, -3%. You can see that the US recently underperformed a lot of places around the world. With the tariff announcements, it was a big underperformance, but it has since snapped back. So that's a great chart to see. You can see in the 80s how well the world equities or global equities outperformed the US. And then we had, again, a period of outperformance in the 90s, mid 2000s, again, global equities outperformed. So a great chart just to show you how dominating, how important, of course, the US markets are to individual investors. Our next chart, another great chart showing us where are the dominant companies in the world today. Why do I tell you, the investor, you need to be investing in the US? You want to invest globally, but the US is most important. Take a look at the largest companies by market cap. And I think many shows ago, we had a similar chart up. Take a look at these names: NVIDIA, Microsoft, Apple, Amazon, Alphabet, and Meta. Your top 6 companies, all US and all tech, I might add as well. Then you get Saudi Aramco, very large company out of Saudi Arabia. Obviously, oil, a big reason for why they come in at 2.2 trillion in market cap. But then right after that, Broadcom, we had Broadcom. We showed a chart of Broadcom. Some people say Mag 7. I'm going to call it the grade 8 because I think you can add Broadcom there. $1 trillion company as well. TSMC, which is Taiwan Semiconductor, obviously out of Taiwan, although they have a lot of business in the US, building factories in the US. They come in as well, just over $1 trillion, 1.5 trillion. And then once again, the last 3 out of the 12 listed here: Berkshire Hathaway, Warren Buffett's company, Tesla, and Walmart. These are the biggest companies in the world. And if that isn't a reason that individual investors should be putting some money, and I would say quite a bit of their money in the US, I don't know what is. We hear from Canada Pension, we hear from mutual fund companies, and their Canadian mutual funds investing as much as 40 to 48% abroad, much of that in the US. They have to keep at least 50 or 51% to be considered Canadian, but everything else seems to be going outside of Canada. And again, that has changed a lot over the years. Since I've started in the business over the last 26 years, that number has changed a lot. Next chart really shows the US dominance. Top 10 countries by nominal GDP as of 2025. United States at the top, 30 trillion in nominal GDP. Everybody talks about China catching the US. Well, they've come a long way, but they're still not even 20 trillion. So they're still over 10 trillion away. And then you have Germany, the 3rd largest, Japan 4th, India 5th, United Kingdom now 6th. Canada sits 2.3, and we are a little bit away, And actually, it's interesting. Brazil, not many people know this. Brazil is one of the top countries in terms of growth as well. So you want to be patriotic. That's fantastic. I agree with it. I think we should try and support businesses in our country, local businesses. But when it comes to your hard-earned investments, the money that you want to put to work to help you grow your portfolio, the money you want for growth, in my opinion, I think you need to be looking outside of Canada quite often, as many of the pension funds and the mutual funds do. I think you want to look to the US, which is where, as you've just seen, many of the best quality and biggest names exist today anywhere in the world. Quick hits. These are three things that I've seen in the news recently that I wanted to kind of touch on or comment on very briefly. Canada to boost defense spending. There's a 2% target, right? 2% of GDP this fiscal year. That's the target that NATO wants, that all countries that are members of NATO should have. And I know that Canada has been significantly below that. So we're going to look at that. We have a chart to show on that. Apple's WWDC underwhelms. Apple's annual conference that happens every June. We were all hoping for good things. We were actually expecting not so much, and we got even less than that. This whole idea of AI coming into Apple products just looks to be delayed and behind everybody else. And lastly, Canada tourism. Canadian tourism groups are telling people in the US, come to Canada. Even though we have some tensions between the two countries, we welcome tourism from the United States. So let's look at our first quick hit, which is Canada boosting spending. And we have one chart that I'd like to show with that. And it clearly shows how far behind Canada has been to the other major countries, NATO countries. You can see there you have it. US obviously spends the most. Actually, not so true. I should take that back. Poland is the spending leader. It's a small country. They are in, obviously, Europe. They tend to spend the most, or they do spend the most on defense at this point in time. They've been buying a lot of planes from U.S. companies, from Lockheed Martin and others, and Poland is spending the most. You can see here, Canada is right at the bottom of that quick little list there of dots, but they're going to increase their spending. And what does that mean? Well, that could mean some nice contracts for some defense companies in Canada. CAE comes to mind. Perhaps some contracts out of the U.S., Lockheed Martin, Northrop Grumman, General Dynamics, RTX, formerly Raytheon. These are companies that are known right across the globe for defense, and countries look to these companies to provide defense, whether it's planes, whether it's anything to do with ammunition, guns, and all kinds of things, drones, surveillance. This is what countries are looking at right now. So defense spending going up very quickly by Prime Minister Carney here in Canada. Our next topic is as I said, the conference that Apple has, WWDC, underwhelms on AI. We have a chart on Apple, and really this whole idea of a trade war, tariffs, and this I guess back and forth between President Trump and CEO of Apple, talking about President Trump wanting Apple to produce iPhones in the US. CEO of Apple saying, Tim Cook saying, that isn't going to happen. It's just way too expensive to do that. That coupled with the delay in artificial intelligence. And you can see how much Apple stock has fallen. Once upon a time, back at the end of 2024, beginning of 25, stock was over 250. Today, it trades just over $200 a share. So we're going to have to see what Apple has up its sleeve with respect to artificial intelligence and incorporating AI more and more into its products. Our third quick hit, Canadian tourism. We're noticing that US, they're not coming up to Canada as much. Perhaps it's because they're just afraid on how they're going to be received. I know many Americans love Canadians. They love coming up here. But right now, with the trade wars going on between Canada and the US, just not making the trip up here as much. And I think people in Canada are staying in Canada. People in the US are staying in the US. But I think both Canadians and Americans are traveling to Europe. So maybe Europe is actually reaping the rewards of tourism with respect to these tariffs and what's going on with the trade war. We have a very quick chart here which shows by car and by air in April and in May. It's getting a little better in May. People are definitely coming up to Canada more so in May. Perhaps the weather has gotten better. That also helps. But definitely tourism is down. I know tourism is down in the US from Canadians going to the US as well. So, yeah, this is just collateral damage, right? When you have a trade war between trading partners, best of friends over many, many years, trade wars, this is the collateral damage that you have, trade and travel. So those are the three quick hits that I wanted to talk to all of you today and comment on today as well. Now the part of the show where I try to take a question or two. And one question I saw come in, and I've been asked this question quite a bit from my investors as well as investors that I've met in my travels, going on BNN or going on CP24 or just meeting people in different areas. And that is the question about this one big, beautiful bill that looks to be passed at some point in the US. And that's what President Trump calls it. Canadian investors who own U.S. securities may face significant tax hikes as the bill is going through the Senate for approval. Do you recommend Canadian investors take a closer look at their overall U.S. exposure? So just briefly, this tax bill, I think the specific part of the bill is Bill 899. It talks about increasing the withholding tax that Canadians will have to pay on U.S. income. So if you buy a U.S. stock and it pays a dividend right now, most of us pay 15% withholding tax. Well, that, according to this bill, will be increased over the years until it gets all the way up to 50% withholding tax. And so many investors are wondering, is this a sign? Should we be getting out of our U.S. investments? Simply put, I wouldn't be doing anything right now. So far, the bill has not passed. It may be changed multiple times before it is passed. I know that as investors, we like to try and get ahead of things. But this one is one of those things that I'm going to take a wait and see approach on. The other thing to keep in mind is what are your investments, right? If you have investments that are paying you U.S. dividends, then yes, this may at some point affect taxes paid on those U.S. dividends. But if you're buying a stock like Amazon that pays no dividend, then you shouldn't really worry because capital gains tax you're going to pay here in Canada, and there is no income that the U.S. is going to tax or increase your taxes on. So it's going to be dependent on what the bill looks like, what Canada can do to lower that, because the U.S. apparently is putting on or wanting to increase this withholding tax because Canada puts a digital tax on certain companies, U.S. companies here in Canada. So maybe Canada can reduce or remove our tax, and then the U.S. will do the same. We'll have to see what the bill looks like and what the negotiations between U.S. and Canada look like going forward. But for now, I would say hold tight with your U.S. investments. I wouldn't be changing anything at this point in time. And when we get the final bill and what it looks like, then we can make decisions for individuals' investment portfolio. So with that, I want to say thanks to everybody once again for watching our show. I hope everybody could take away something from the show, a piece of information. I hope I was able to answer perhaps one or maybe even a couple of questions that you may have regarding the markets, tariffs, taxes, and our overall economy. And if I did that, then I'm very pleased. And that's what we try to do here on every Allan Small Financial Show. So with that, I want to say thanks again. And please tune in 2 weeks from today, which is, yes, wow, June the 25th, almost the end of June, will be our next show at 12 noon, where we'll be talking about more questions, more ideas that I'm hearing from individual investors. As always, that is the goal of our show. So until June the 25th, I want to wish everybody happy investing.